Today, the Federal Reserve will conclude its two-day meeting, the penultimate one of the year. While the formal outcomes of the October meeting are largely predetermined, markets are speculating about the intrigue surrounding the Fed's future actions. As the American trading session comes to a close, the Federal Reserve faces unprecedented circumstances, first time in 6 years that its members gather amidst a shutdown that has stretched into its 29th day, just 5 days shy of a historical record. Unlike the January meeting in 2019, when the central bank maintained all parameters, today the regulator is expected to lower the funds rate by 25 basis points. This is the most basic and anticipated scenario, with the market assigning a 99.9% probability to its realization. This suggests that formal outcomes of the October meeting have already been factored into market prices. Traders priced in a 25 basis point rate cut 2 weeks ago following a significant speech by Fed Chair Jerome Powell, who expressed concern over the state of the labor market, stating the ongoing reduction in job openings will inevitably lead to an increase in unemployment. Other Fed policymakers, including Stephen Merrin, Christopher Waller, and Michelle Bowman, supported further monetary easing, intensifying the market's expectations. In essence, an October rate cut appears to be a done deal. Consequently, traders may choose to disregard the formal announcement of the meeting's outcomes. All attention will be focused on the accompanying statement and the rhetoric from Jerome Powell. The intrigue surrounding the Fed's next steps persists, and several primary scenarios can be delineated. Hawkish cut, in my opinion, is the most likely scenario, wherein the regulator will cut the interest rate by 25 basis points but refrain from announcing another rate cut for the December meeting. The Fed will deliver a cautious message, suggesting that future decisions will be based on incoming data, specifically after the shutdown concludes. Essentially, the central bank is currently operating in the dark, with its members making decisions solely based on the September CPI growth report. Unfortunately, other official macroeconomic statistics are unavailable. Will the Fed make any categorical forecasts in such an information vacuum? Highly unlikely, especially since not all Fed representatives align with Jerome Powell's dovish stance. Notably, Dallas Fed President Lori Logan and Atlanta Fed President Raphael Bostic have called for caution regarding further rate cuts. Moreover, the October Fed meeting occurs on the eve of a crucial meeting between U.S. President Donald Trump and Chinese President Xi Jinping. Preliminary trade talks have been constructive, however. If the leaders fail to find common ground on key issues, the trade war may escalate once again. This potential scenario cannot be overlooked, serving as another argument for a cautious position from the Fed regarding its future actions. Importantly, according to the CME Fed Watch Tool data, the probability of a 25 basis point rate cut in December stands at 90. Therefore, if the Fed pursues a hawkish cut today, the dollar will likely see increased demand, even in the face of an actual rate cut. Dovish cut, a 25 basis point rate cut coupled with unequivocal hints at another cut in December. This scenario is less likely due to the reasons mentioned above. However, it cannot be completely dismissed. Proponents of this outcome point to the aforementioned CPI report from September, which revealed a slower overall inflation rate 3.0 against a forecast of 3.1 and a deceleration in core inflation 3.0, following August's increase to 3.1. Regarding the labor market, doves highlight a rise in unemployment benefit claims. Once again, due to the ongoing shutdown, the U.S. Department of Labor has not published official data. However, estimates from Goldman Sachs and JP Morgan suggest that the number of Americans initially filing for unemployment benefits has risen for the third consecutive week. Similar signals have been voiced by Citigroup economists, who estimate an increase in claims last week to 230,000–235,000. All of this indicates that demand in the labor market continues to wane. Some analysts believe the increase in claims could be attributed to the shutdown. As a rule, surges occur only in the first week following a government work stoppage. In this case, however, we may be witnessing a negative trend. Another argument in favor of a dovish cut is the Conference Board's Consumer Confidence Index, which has declined for the third consecutive month. According to data published yesterday, the index dropped to 94.6, the lowest level since April of this year. In other words, the Federal Reserve could theoretically justify not only the 25 basis point rate cut in October, but also the necessity for further monetary easing. If the emphasis is placed accordingly, the dollar could face significant pressure. Still, in my opinion, the regulator is unlikely to adopt such unanimous decisiveness. Ultra scenarios, these are the least likely scenarios, which could theoretically unfold, but the probability is exceedingly low. For instance, a rate cut of 50 basis points. It's worth noting that, following the September meeting, the 50 basis point scenario was supported only by Trump's protege, Stephen Mnuchin, a consistent duff. Probably, he will also vote for a 50 basis point cut today. However, no one on the committee, apart from him, supports the idea of aggressive monetary easing. Additionally, the option of maintaining the status quo at the October meeting is highly unlikely. Fed Chair Jerome Powell practically announced a rate cut 2 weeks ago. The red tint of the inflation report dispelled any lingering doubts in this regard. Conclusions: the market's unshakable confidence that the Fed will implement 2 rate cuts by the end of this year may prove detrimental to U.S. buyers in every sense. For further growth of the pair, the regulator must confirm market expectations. Will it confirm them? Highly doubtful, given the ongoing shutdown, the upcoming negotiations between Trump and Xi Jinping, and the existing disagreements among Fed members. It means that the greenback could become the beneficiary of the October meeting, even in the face of an actual rate cut. In this case, U.S. sellers may once again test the